Hello and welcome. Strap yourselves in because it's CapTime, where we strive to gather up all of the key and pertinent information for you so you can best allocate your capital in the most intelligent way possible. So let's get started. Today, we are going to go through an interview with market strategist Russell Napier that he recently gave. Very interesting stuff here. He's been calling for deflation for the past couple of decades, but now, correctly so, might I add, but now he's calling for inflation rates of 4% and more by next year. The main reason behind this? The government has control of the money supply. So let's get started and go through this. It says here, politicians have gained control of money supply and they will not give up this instrument anymore, Napier says. In his view, we are at the beginning of a new era of financial repression, in which politicians will make sure that inflation rates remain consistently above government bond yields for years. This is the only way to reduce the crushing levels of debt, argues Napier. So in America, we have over $25 trillion in debt. We do have the world reserve currency, which is the dollar, of course, but there's two options. We either pay off this debt, we default, but then there's a secret option, the third option, and that is inflation. We can just print our way out of 25, 26 trillion and beyond. But inflation is nothing more than a transfer of wealth from savers to debtors. If you have $100,000 in your bank account and the dollar loses, say, 80% of its value, then you've essentially been robbed of $80,000. It's a hidden wealth tax that governments love. Governments always go the path of fiat currency because then they can control the money supply, and therefore they can actually control the transferring of wealth between the savers and the debtors. So let's go scroll down even further here in this interview. It says, so the interview asks him, we've been printing money for the last 10 years through the various iterations of QE, QE1, QE2, but we don't really see this big hyperinflationary or just moderate inflationary environment. Why is that the case? So it says, why has the situation changed? So he says, we are currently in the worst recession since World War II. Let's go skip down here. In the U.S., M2 is the broadest aggregate available, and it's growing up at more than 23%. You'd have to go back to the Civil War to find levels like that. In the Eurozone, M3, which is another broad money aggregate, it's growing at 8.9%. And only in a matter of months, it'll break its previous peak of 11.5%. When you introduce that amount of money in that amount of time, I just want to show you guys how it looks like here on this graph. This is through the St. Louis Fed. It looks at broad money supply, essentially the amount of money. Again, it's the amount of money that's circulating throughout the entire economic system. And it tracks all the way back to 1980, and it goes all the way up to present day. And you see this big jump from roughly, call it 15.5 trillion at the beginning of March, all the way up to currently at 18.3 trillion, a $3 trillion delta increase. To kind of go back and see how long did it actually take us to go from 15.5 trillion to say 12.5 trillion? That's about the same increase that we've seen in the last few months. You'd have to go all the way back to roughly the beginning of or the end of 2015. So you're talking 4 to 5 years. What we've accomplished in 45 years, we've done it in just the span of a few months. And this is a chart here as well that looks at broad money aggregates rising sharply. The U.S. is here denoted in blue. This is a measure of the percentage change in broad money. You see during March, we just jumped sharply 23% here in the U.S. year over year. And so did the Eurozone and Japan, but not nearly to the same extent as we did here in the U.S. So why is this? Why does this actually matter now? Does the growth of broad money matter? And investors don't think so. It hasn't really meant much. Again, the past decade or so with QE. So what's really changed? Um, so the market doesn't really believe that broad money growth matters. Broad money growth, he says, is created by governments intervening in the commercial banking system. Governments can tell commercial banks to grant loans to companies, and they guarantee those loans to the banks. This is money creation in a way that is completely circumventing central banks. So he makes two calls. One, with broad money growth that high, we will get inflation. And more importantly, to control the money supply has moved from central banks to politicians. Politicians have different goals and incentives than central bankers. They need inflation to get rid of the high debt levels like we talked about earlier. And they now have that mechanism to create it. And so they will create it. There's this idea that the central bank here in America, the Federal Reserve, is independent from the government. The rationale behind that is that there's this need to want to decouple monetary policy from politics. So you can't say, so politicians just can't, go around, spouting, vote for me and I'll steal for you through a printing press. It's just a way of keeping monetary policy kind of consistent with the overall reality and not getting it conflated with politics. So another thing that I want to kind of go through with you guys in terms of why there hasn't been much inflation growth the past decade, but we do anticipate there's probably a high likelihood of inflation in the coming years, and that is because of something called money velocity. So with money velocity is essentially, I'm just going to skip all the way down here. Money velocity is essentially it's a metric of how fast money transacts from one party to another on average, roughly. That's the gist of it, essentially. So if you create $1 billion out of thin air, but then all you do is put it under your mattress, that money isn't circulating around the economy. So consumer prices aren't being impacted. It's not influencing the demand within the economy. It's not like people have an additional 1 billion divided by 300 million people in the U.S. It's not like they have those extra dollars in their pockets to actually influence their purchasing behavior. That money's kind of on the sidelines. That's sort of what happened with QE1, QE2. It all was diverted into bank reserves. So you don't really see that inflation, even though you have this broad money supply increase. It's just not there just because the money velocity has been so low. And this is a graph here of the money velocity for the last 20 years or so. And you can kind of see it's been on a downward trend. To kind of get a broader look at things, throughout 1962 today, it held fairly consistent up until the the early 1990s. It jumped all the way up until the mid 1990s, and then at the beginning of the year 2000, we started to see a drop in money velocity. People aren't spending as much money. All the additional money created into the broad money supply is just being kind of hoarded up in bank reserves and so forth. So to kind of wrap it all up, people like Russell Napier, he's been calling for disinflation throughout all this time. Now he's going through and calling for inflation, rates as high as 4%. It could possibly even higher. Here he says there's no reason money velocity could stop at 1.4. Currently it's at 0.8. So if it's at 1.4, that's almost a 100% increase, just below that actually. So when you increase the money supply, but you also increase the money velocity, because that money is actually now getting into the hands of people through the stimulus checks. It's actually getting into the real economy. So buyer beware, brace for inflation in the near future. That is today's episode of CapTime. Thank you so much. Please like and subscribe if you like this kind of information. I will be posting updates throughout the week. So thank you, and thank you so much for your time. Bye-bye.